All right, good morning, everyone. I wanted to go ahead and review Friday's price action. The first thing that sticks out to me on the open is the idea of taking a limit order short right here. So what we had two bear bars down, and then this inside bull bar with this big tail on the top. So how many of you want to buy above this bar? It's a weak signal bar with following two bear bars. So two bear bars, probably we're going to get a second leg down off of this, even though it doesn't have to be very large, but we're going to at least get a little bit more down. So if the market goes above this bar, they'd also be buying into the moving average. So there's probably more sellers above this than buyers. This is one of those examples of a weak signal bar when it's probably better to do the opposite. So I'm going to mark this as a limit order short. Now, why would I not mark this or above this bear bar as a limit order short? Well, I wouldn't mark this bull bar because now we have had the two legs down. So one leg, pull back, second leg, and a bull bar. And it's closing much closer to its high compared to this bar. So I wouldn't want to sell above this. In fact, more people would probably buy above this, and that did end up as a winning long trade. Then what about selling above this bear bar? Well, what's different now is, once again, we have had the two legs down, and we are farther from the moving average. And so after these two legs down, we're still kind of in this time of reversal. So this might just be an opening reversal, and then we move up. We're farther from the moving average, so I would rather not be selling above here. So as far as the limit orders on the open, I would just be looking at this one as being the reasonable one to take. Possible swing trade idea would be to look to sell below this bear bar. Now, if you're selling here, the reason you do this, one, is because it's effectively a double top. So we have this high, the market moved down, and then try to go up higher. And even though this high and this high are not the same price, they're effectively two attempts to go higher on the open, two attempts to go higher below the moving average. Possibly this would be the start of a move down. Now, if I was going short there, I would not go for a scalp. I would not go for 10 points. At a minimum, I would try to go for 2 times my risk. And in this case, I would probably even try to go for more than that. Because we've kind of been in a bullish to sideways market. So the odds aren't that great of this being a successful short. Also, in my mind, I can see prior examples of days like this where they've had some sort of double top early on the open. And when those days happened, it ended up being a huge bear day. It might have looked like something like getting down here. So the odds aren't all that high, but the potential for profit is very large, and we do have a reasonable setup. So with those criteria, we want to be going for a swing trade, probably more than 2 times the risk, probably like 3 or 4 or 5 times. Because if this is going to go down, if this is the start of a bear trend day, then there's actually going to be a lot more down. So to offset our lower probability, we need to expand our profit target out. 4 bull bars on the open, all of them closing above their midpoints, closing reasonably well. Now we've had one close above the previous high, and then the second close above the previous high. We'll probably get a second leg off of this. Now, that makes me want to buy below a weak sell signal bar. And the first time a bar goes below that is here, but this isn't all that weak of a sell signal, so I wouldn't buy below this. Although if this was a bull bar and the market went below that bull bar, I would be interested in going for a limit order and buying there. So it would be like buying here, but this bear bar just isn't weak enough for me to want to buy below it. Even though we see you could have bought and gotten your scalp. The limit order entry there for me just wasn't good enough. What about buying below the bull bar? Well, if you're able to if your betting today will be a trading range day, which we've gotten some data that it might be trading range day. We've gone down, then we've gone up, and we really haven't gone too far, an hour into the day. Well, then you'd be buying high in the trading range, which generally is not a good idea. You'd have to be willing to buy here and hold for possibly for several hours. And what happens if you get this breakout like this? Are you still going to be able to hold, or are you going to exit down here? So I always find it difficult to try to manage buying high in the range. It's better to try to buy lower in the range. So if I'm buying here, to be able to make profit on this, I'd have to actually be able to hold all through this and then wait for it to come back later in the day. Which, one, isn't fun to do, and then two, I mean, it's just difficult. Like, you see this, and I'm sure you're going to think you're wrong on the premise that it's a trading range day. You also don't know, is this some kind of news and the market's going to go way more lower? You just don't know. So for these reasons, even though you probably could at least avoid a loss buying below this, it's probably easier to avoid it and wait till you get a sell setup higher in the range or a buy setup lower in the range. Sell setup higher in the range, for example here. We have a bear bar closing below the moving average, closing below the open of the day. If it goes above this, probably going to be sellers above it, at least initially. Right? This isn't a good-looking bull bar. They're probably going to be sellers above this bar for limit order, and they'll sell above. They'll go for 5 points, and they'll get out with a scalp right here. So if you had just taken 2 trades at this point today, you would have sold here above this bar, 5 points, and then sold here above this bar and gotten 5 points. And both of them are reasonable. Neither of them were buying too high in the range or selling too low in the range. So there's 2 reasonable scalps within the first hour or so. As we get more bars, what about selling above here? That could be okay. I mean, it's still going to be decently high probability. I'm going to mark it as I sell. Below the moving average, good looking bear bar, probably not too many buyers above, so sellers above there should be able to make money. One issue you might run into if you do sell here is that you start to get this bullish looking pattern. Okay, so we had a pretty strong move up here. We might look to get a second leg up after this somewhere over here. You're also getting a wedge. So first push, pullback, second push, pullback, third push. So you have a wedge pattern, a reversal pattern, means the market might try to go higher. And after this wedge pattern, you get this bull bar, and then a follow through bull bar. So if you're selling here, and then you notice you get this wedge, and then you get this good looking bull bar, it might be better to just exit above this bull bar. Okay, so you sell here, and you see the bull bar, and you have a chance to get out break even if you're into this trade. So you can get out break even or with a profit here. That might be better to do. So if it goes above this bull bar and you're short, I'd probably just be better to just take your small loss, just lose your point and a half, and just avoid it. Because if you stay in the trade, you're risking this being a wedge bottom and then the market goes higher. And you don't want to be in during that. Buying above here, well, I don't like to buy above this bar because it's going right into the moving average. But then buying above here, the market did not go above that bar, so you would not be entering a long trade there. With this wedge bottom failing, and we see with the bulls failing here, then the market starts to head lower. So after this wedge pattern, we would expect there to be more up, but we never really got good buying, and we ended up below the moving average instead of above it. So now we're back below the moving average. First leg up, pull back, second leg, and we're getting stuck below the moving average here. So yes, strong bull close, but then follow through is bad, this bear bar. Now what about selling below this bar with this double top, clearly that would have worked out. However, the issue is selling here. I don't like trying to sell right after this strong bull bar. Right, the bulls were, even though they got bad follow through, they were strong enough to be able to close it above the moving average and at the high of the bar. So for me, I would rather see a second bear bar during here to sell below that, and we didn't get that. Instead, we got a very large bear bar closing much lower. So for me, I probably would have been left out of this trade unless I went down to a lower time frame and looked for a short somewhere down here, which is probably what I would recommend if you're seeing this. So your odds aren't too high selling below here, but if you do end up selling, I think you probably know what I'm going to say. You need to go for a profit much larger than your risk. Your odds aren't too high here, but if this does end up as a double top bull trap, then the market is probably going to go a lot lower. So if you are selling around here, try to go for a swing trade, because if you're scalping, I don't think your odds are going to be high enough. 5 bear bars down, probably get a second leg, so pull back, second leg. And then now the bulls see this, so they're going to try to create a bottom here. And it doesn't take too long before they are able to get their double bottom. So double bottom, 3 bull bars, pretty good looking bull bars, not yet enough to offset all this selling, but we have had a double bottom, and we want to look for the bears to fail. Do they fail trying to go lower, or are they able to succeed in going lower? Well, they get a higher double bottom here. Right, one attempt lower, second attempt lower. Now the market gets above the moving average, and we end up with another higher low double bottom. So one attempt to go lower, second attempt to go lower. Now we've had a series of these higher lows, and now we're getting above the moving average. So I like this bull bar for a swing trade above that. The bears were making money, and then they tried to go lower once, and then several times they tried to go lower, but they ended up higher than they did before. So if they sold down here, they're getting worried, and this is starting to become the exit zone for them. So at any point, the market might have reversed back down and gotten a larger second leg off of this, but it didn't. So a swing trade would look like this. So when we have bears exiting here, we want to be buying where they're exiting, and usually there's evidence in the market when there's traps. So we were talking about the idea of bulls. There was a pretty strong bull bar here. They were probably trapped if the market goes lower, and it did. So then all the bulls that bought here or here or here, they rushed out, and the market rushed down. Here, the bears were rushing out, and then the market had 4 strong bull bars up and then follow through. So that's one way you can study, actually, is look for these fairly sharp moves and what preceded that, and you'll often see a trap of some sort. So for bear bars, we're now in a bull trend, and what do we get in this bull trend? We get a double bottom at also the 5,900 big round number. So double bottom in a bull trend at support. This is a good buy for a swing trade. Buying above this bull bar, and you can say, well, but it's following this bear bar and it's following this overlap. Yes, that's true. That does decrease the probability. So if I'm buying here, it needs to be a swing trade. Okay, so buying here for a swing trade. Then you get a follow through bar, then a third follow through bar, this little bull doji. So I want to continue trying to buy here. And now that we have gotten some, now that we have gotten consecutive bull bars and we're getting follow through, even though this is a doji bar, like it's a weak bull bar, I actually think this is okay for a scalp or for a swing. We have room to the highs over here. We're in a bull trend. We're coming off of a double bottom. If it goes above here, it's probably going higher. That's probably good for a scalp or for a swing. Then after that, market failed to get above the high of the day, and it pulled back and closed right around the open. All right, here's our opening price, and we see all these little tails late in the day, and that was the market failing to go higher. And what is the safe price to come back to at the end of the day? It's the open. So if the market can't go lower, if it can't go higher, where do traders feel safe? It is to end the market, especially going into the weekend. It's probably going to be safe around the open because we've already proven that this price is correct. We also closed around this price. So if we're somewhere in here, then it was the correct price before, so it's going to be somewhat of a safe price again to close around, and that's where we ended up closing. So that's my review. I made sure I wanted to add in some of these limit order trades, and I'll probably go ahead and record some of these next week, and we'll post a video of the live trade of that. Yeah, so this they had some limit order trades and some scalps and some swing trades. So you know, it's nice when days kind of have all of the different types of trades, and a lot of days do really. So you just kind of got to look for, you got to wait for that setup to come to you, and then take that when it presents itself. All right, tomorrow's Monday, and see you guys then.